He kōna ipurangi tēnei nā te reo irirangi o Aotearoa.
If you die without family, what happens to your KiwiSaver? Is it fair that a household with one high earner pays more tax than one with two average earners? And what is productivity, and why does it matter to the average New Zealander who's just focused on getting their own job done? That's what we're getting into this time. I'm Susan Edmunds, RNZ's money correspondent, and this is No Stupid Questions, the podcast that wants to get you answers to all your money questions. I'm joined by Justin Gregory, who's been sorting through your questions.
And occasionally adding my own in there. Shall we get into it, Susan?
Let's do it.
Right, now you'll remember a couple of weeks ago we talked about what landlords are not allowed to do, and fair's fair, time we do the same for tenants. Susan, you got into this in an article recently, and there's one big no-no, right?
Yes, that's right. The biggest thing that catches people out is that you can't withhold rent. Even if your landlord isn't doing something that you think they should be doing, maybe they're being a bit rubbish with the maintenance, or even they haven't met their healthy homes obligations, you have to take your complaints about that down the right channel. You can't unilaterally stop paying rent. I found a couple of recent tenancy tribunal cases where people had either stopped paying or reduced their rent to get their landlord's attention, and it wasn't looked on favourably by the tribunal, even though they might have been in the right, theoretically.
Yeah, I mean, tenants can feel a bit helpless in this kind of situation, eh? So withholding your rent seems, as you say, like a way to get someone's attention or the fair thing to do, but it's not. Don't do it. What is the right way to do it? Because this becomes a bit of a power issue, yeah?
I think so. There is often a bit of an imbalance there. The right way to tackle it is to issue a 14-day notice to remedy, which is basically what it sounds like. You're telling your landlord that there's something that needs fixing and they have 14 days to sort it. And if they don't, you can go to the tenancy tribunal for an order.
What happens if the landlord takes that badly?
Landlords legally aren't allowed to kick you out in retaliation, so you're within your rights to do this and know that you won't be asked to leave because of it. At the moment, tenants have a bit more power in the market than in recent years too, so as long as you keep your discussions professional, you should feel that you're entitled to exercise your rights. Other things that I spotted were not telling landlords about damage, having more than the agreed maximum number of occupants, and running a business on a property.
Heaps of us work from home though now. What about that?
That's true. I checked into this afterwards because someone else emailed me with a similar question, and it comes down to basically how you're using the house, because most landlord insurance policies are pretty much like the Residential Tenancies Act, which says that a house has to be primarily used for residential purposes. So you can probably have a home office with no problem, but the house still needs to be primarily used for residential stuff.
And on a related note, our next question is from Ella, and she's got a question about flatmates. Okay. She says she bought her house on her own, but is looking to get some people in to help pay down the mortgage more quickly. Fair enough. She says, I'm thinking of drawing up my own flatmate agreement, but in the process have gotten into a bit of a rabbit hole about the income tax implications of flatmates versus boarders. Now, the confusing bit is for the purpose of drawing down the mortgage, any housemate was seen as a boarder, in parentheses, but now it seems, according to IRD, that there's a difference both in terms of your actual living arrangement and tax implications. For example, a boarder, you have to provide at least one meal a day and can only charge up to $237 per week before you have to pay tax on that income. Whereas a flatmate is more normal, e.g. you split bills, can just charge for rent, but then there seems to be quite a complicated tax process in terms of working out square meterage of the house parts that are shared or exclusive for flatmate use and splitting expenses, again, for example, on rates or insurance or chattels. And this is based off your potential tax bill on the income. Am I correct in my interpretation of all this, asks Ella, or is it far more simple? It could only be far more simple, Susan, please.
I was just thinking that, actually. So Inland Revenue sets an amount every year that you can charge a boarder without having to worry about tax or doing a tax return, anything like that, which is the $237 a week that Ella mentioned. And that's designed to take into account all the costs of having a boarder in your home. IRD says a boarder is someone who lives in your home and gets meals and some other care and services as part of their rent. But I do know this is interpreted quite flexibly by some people. I chatted to a friend of the show, Deloitte tax partner Robin Walker, about this. She says if you decide to set your situation up as flatmates instead, all the money you receive is assessable income. So it's income that IRD will want to know about. And then you need to work out the extent to which a property is being used for renting out and which bit you're living in yourself, and then apportion the costs accordingly. So you can only claim tax deductions for the bit that is earning you the rental income. You can't claim your own private costs, which I guess makes sense. So she says, this is a tax exercise, but it probably doesn't hurt to do this from a general budgeting perspective too, to make sure you understand all your costs of ownership. So working out the floor space allocation between the bits that you only use, the bits that your flatmates only use, and then the bits that you share. She says that should be a reasonably straightforward exercise and something that you only need to do once, or every time, I don't know, you change the configuration of your house, that sort of thing. So if you have a house that's 100 square metres and you have a 20 square metre bedroom each, and the balance of the floor space is common space, in that case, 50% of all costs will be deductible. That's 50% of insurance, rates, utilities, repairs, interest. You can claim that all as a tax deduction from the tax that you would pay on the rental income that you're getting in.
Might be a good idea for you to look that up online if you're listening to this one, Ella, so that we can confirm all those details. Podcasts aren't great at carrying numbers and specifics like that, but there you go. Next question, and this one comes from me, quite frankly. It's about productivity. Every time someone complains about our low wages, we're told it's because of our low productivity in this country. Now, I don't really get that because I work pretty hard. Everyone I know works pretty hard. So what is productivity? Why are we supposed to be so bad at it? And are we really? Susan?
In a mathematical sense, productivity is the amount of output generated divided by the number of hours being worked. If you're allergic to maths, as I am, it's a question of what resources are being put into producing stuff and what you're getting on the other side. For a bit more of an explanation, I talked to Brad Olsen at Infometrics.
So productivity is how much you can get out of something for how much you can put in. So effectively, output per worker, the amount of goods and services that each worker or production process produces and the value that they add. And so when we talk about changes in productivity, what we're talking about is either the inputs or the outputs. So you might have the same one person that used to work 40 hours a week and produced 100 widgets. And those widgets sold at $10 a pop. If you then have the same person working the same 40 hours a week, but now they make 200 widgets, or they make 100 widgets but are worth $20, then you start to get that productivity gain. Equally, it might well be that creating the 100 widgets, because you include some new technology, it only now takes a shorter amount of time to create the same number of widgets as before. So your total time is still 40 hours. It only takes you 20 hours to make the first 100. So you've got more time then to make more options because you've sort of lowered that input cost. So it's effectively how much you can produce out given a certain amount of inputs.
Okay, so it doesn't mean that you have to work harder.
It doesn't mean you have to work. No, in fact, if you're getting productivity gains, you're not necessarily working harder, you're generally working smarter. And the concept there would be, how do we either improve the sort of skills that people have so they can do their job more efficiently and effectively faster? How do we use technology in different ways? Or how do we find a way that instead of having to work the same number of hours for a lower dollar value, that you find a product or you find a way to make more money from that same product, which means that you're not having to work any differently, but you're making more money from it at the end of the day.
Okay. And so why does it seem that we're not very good at this?
Well, there's a lot of reasons, a lot of challenges. Some of those are around the likes of our investment into what we call capital, but basically machines, technology, and similar. If we all were using, say, AI to its fullest advantage, there'd be a whole lot of things that we wouldn't have to do as a worker in our daily lives because the AI would do it for us. That'd leave us more time to do the things that actually could then produce value. If we all had an extra hour or so a day, if we're a sales agent, that's 5 more phone calls you might be able to fit in and sort of work with different people to make those sales. Or if you're an engineer, it could be a whole lot more time that you could then be, changing up the process so that you're making your widgets a whole lot faster than they were before, or that not as many of them break at first and similar. So it's really about that technology investment. Sometimes it's around infrastructure. If you've built something or created something, but you can't move it from where you've produced it to where people want it, then again, all of that costs time and money. And then there's some of the educational outcomes as well. It's very hard to have people that do, some exceptional sort of science and technology, rocket ship building and similar, if they can't do basic maths. So over time, we're generally seeing a need for improvement in all of those areas. Key infrastructure, education, and the likes of using technology and investment into capital a whole lot smarter over time.
Okay. Brilliant. I think that answers it very well. Thank you. I appreciate that.
That's all right. Productivity it's one of those things. I think one of the points that's made in economics is productivity isn't everything, but over the long run, it's just about everything. Because without productivity gains, you don't get higher standards of living, you don't get wages that improve and similar. Effectively, if you're able to make more stuff over time with either less inputs, or you can sort of do things more efficiently, that's more money that's starting to be generated, and that money over time does go back to workers.
Now, a couple of quick-fire questions, all along similar lines. Malcolm wants to know what happens to his KiwiSaver if he dies. He has a wife, but no children. Similarly, Jaiti, we think that's how her name is pronounced, raised a similar concern. They were worried that their KiwiSaver money could go to the bank or the government if they died without anyone to pass it on to. So what's the deal there, Susan?
KiwiSaver becomes part of your estate if you die. If you have a will, it's distributed according to that, so that's easy. But if you don't, there are rules that kick in. If you have a spouse and no kids, the spouse gets the whole thing. They might also have a claim under the Relationship Property Act anyway, because it's relationship property. When you have a spouse and kids and you don't have a will, your spouse gets your personal effects, which is stuff like your furniture. They get $155,000, provided you have it, and a third of anything that's left. And then kids get the other 2/3. If you don't have kids, your parents can claim a third. So there's all these different permutations of how that would work. If you don't have any family at all and no one can find anyone who might be reasonable to inherit your money, the money could go to the government. Public Trust says anyone who thinks they should have benefited from the estate can then apply to the Treasury to be considered.
Or you could give it to the dog. People used to give stuff to their dogs all the time.
Yeah. Can you hear my dog snoring? I keep looking at him and shh.
I can't, but I wish I could. And our final question is from Julia, and it's about tax. Yeah, cool. Let's do this one. She says, when the children were younger, my husband stayed home some years to provide parenting and stability. Julia worked crazy shift work hours those years. Since going back to the workforce, her husband has worked part-time, he's been laid off, opened his own business, which netted part-time income. He's worked casually, been injured, spent time not working, spent years getting interviews without landing jobs. Basically, he's had a tough time. And I don't think he's earned over $20,000 in a year for some years. Julia says, I earn a little over $120,000 a year now, and while my husband was off work with injury, surgery, recovering our household income, initially there were 2 adults, 2 then 1 child at home, and then 1 child out of home at uni. It was a student getting our help, and there was my income. I'm aware that I earn a good income, and after 20 years in my profession, I'm proud that I've made a good career. Good on you, Julia. We have friends who both work full-time, and there's a good chance I was making their income combined. But because theirs was between 2 people, according to the tax calculator I used, they would be $10,000 per annum better off as a family. Julia says it would be great if I could be allocating some of my income to my husband's IRD number to be taxed at his lower rate. We are married, my income is supporting him. She says, I get that households can be very diverse and this would take some thought, but a financially dependent adult who is receiving nothing from the government seems like a good place to start. She also says it might help when families want to make the choice to have a parent at home with the children. So is this income splitting?
Yeah, this is income splitting. I've looked into it recently, actually, because Stephanie Powell, who's founder of Crayon, which is a company that does a lot of work helping businesses and parents cope with parental leave and the parenting juggle, she says there's some potential unfairness because a couple earning $55,000 each would pay $16,400 in total tax, but a couple where one person is earning $110,000 would pay $26,180 in tax every year. And she points out that some other countries allow joint filing, so it seems something that we could consider here. And it does seem a bit odd that we work out working for families, credits, benefit entitlements, all that sort of thing, on the basis of household income, but we don't do the same for tax. But we did actually look into this in 2009. It was a United Future. You remember them? That was one of their things. And some initial work was done on an income splitting tax credit that at that point would have benefited about 300,000 families or 60% of families with dependent kids, but it didn't really go any further.
2026 is an election year. You reckon this could get back on the table with one of the parties?
I don't, because it seems to me that what we're pushing for is actually the opposite. A lot of the criticism of the system as it stands at the moment that I hear is that we should be moving away from the household model of income and more towards an individual sort of system. And I'm also not sure how much appetite there is for helping higher income earners pay less tax, even if they are supporting a family. And I would note that both families in this scenario would get working for families credits.
Right, that's all your questions for today. Now it's our turn. Last time we asked you which was New Zealand's first bank to open, and turns out it wasn't our bank at all. Although there's some dispute about this, Susan, between you and me.
Yeah, so we've been going back and forth on this because around 1840, it seems like banks became a thing in New Zealand. And we had the Union Bank of Australia and we had the New Zealand Banking Company. But it looks to me like the New Zealand Banking Company set itself up, but didn't get a branch until 2 years later, whereas I think the Aussies had their bank in 1840 in Auckland.
All right, we will agree to disagree over that one, and we will invite comments from the audience, from anyone who might know a little bit more than us. I will say, though, that the New Zealand Banking Company folded 5 years later in 1845, whereas the Union Bank of Australia carried on and in the 1950s merged with another bank to become the Australia and New Zealand Bank Limited, catchy name, and we now know that bank as ANZ. ANZ.
Yes.
Not an endorsement, but good on them for surviving so long.
But our biggest bank, so still.
And this week our question for you is, we're asking, when the student loan scheme was set up in 1992, I remember it well, what was the rate of interest being charged at the time? And follow-up question, what's the average time to repay a loan? Now, I'm terribly prone to telling sort of personal stories in this podcast, so I'm just going to tell you another one. I took out my first loan in 1992. I paid it back fully in 2024. And it was the same week that I finished paying off my student loan, I also finished off paying daycare fees. That was a good week.
I can imagine.
Yeah. It's all been absorbed since then, of course, because that's the nature of things. But I mean, I remember signing up for these things. We were getting these brochures with like pictures of, young people our age on them with surfboards and, riding mountain bikes. And it was a fine line between whether they were kind of encouraging you to take out as much money as you could or just saying, hey, you've got a lifestyle, enjoy it. So, yeah. Dunno.
Yeah, I started university about 10 years later. But I remember before I started, when I was still at high school, my friends would be on the phone ringing up, asking for more money in their bank account, something like course-related costs or something. And it just seemed like this endless stream of money coming in.
Yeah,
we didn't get that.
You didn't get that, no. We used to get like a full semester's worth of student loan living costs in one big whack. So like $1,500 would suddenly arrive inside your bank account. And you're supposed to make this last for the entire term. I mean, some of us did, some of us didn't. But anyway, it's all a bit different now, and I think there's a maximum period of 7 years that you can take out a loan for now, depending on circumstances.
There is a limit, yeah. Send your answers as well as any observations about early banking or student loans or anything that you want to share with us to questions@rnz.co.nz, as well as any other money questions you might have. No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds. That's me. Justin Gregory is the producer. The engineer is Phil Benj. Thanks to Ella, Malcolm, JT, Julia and Justin for their questions, and Brad Olsen, Robin Walker and Stephanie Powell for their answers. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode. Bye for now.